Imagine you're just sitting at your desk.
Yeah.
Right? You're staring at your monitors.
Oh, yeah, the classic setup. We've all been there.
Yeah, and you've been watching Bitcoin for, I don't know, 3 hours. It's just been grinding downward. Just this slow, agonizing bleed.
The worst kind of price action.
Exactly. Until it finally reaches this bright, bold line that you drew on your chart yesterday. It perfectly tags yesterday's absolute lowest price. And immediately you see a flash of green, a bounce.
Like magic.
Right. It looks like the most beautiful, obvious textbook support level in the entire world. So you execute, you buy in, you set your stop loss safely just below that line, and you just lean back, waiting for the profits to roll in.
It is a scenario that plays out, gosh, thousands of times a day. I mean, the setup looks completely flawless.
Totally.
The technicals align perfectly with literally every introductory day trading book ever written.
But then, like 30 seconds later, the market seemingly loses its mind. The price violently just completely reverses.
Yeah.
It violently slices through your support line like a hot knife, through butter. It hunts down your exact stop loss, takes your money, kicks you out of the trade. And
here comes the insult.
The absolute ultimate insult. And he instantly rebounds and rockets to the moon without you. It goes exactly where you predicted it would go, but only after liquidating your position.
Which leaves the trader feeling like, like the market is this sentient, malicious entity that is personally watching their specific brokerage account.
Yes. It breeds so much paranoia.
It really does. But what is actually happening in those moments has absolutely nothing to do with bad luck or malicious brokerages. It is a highly orchestrated mechanical process.
And today we are looking at the exact blueprint of how institutions orchestrate that precise trap, and more importantly, how you can position yourself alongside them. Welcome to the deep dive.
Glad to be here for this one.
Our mission today is to basically take a machete to the dense, cluttered jungle of typical day trading indicators.
We are wiping the slate clean.
Exactly. We are going to wipe your chart completely clean and master a highly professional, step-by-step day trading strategy based on just 2 invisible lines.
Lines that, by the way, are drawn 24 hours in advance.
It is a phenomenal framework because it strips trading down to its absolute core mechanics, right? We're talking order book depth, human psychology, and market memory. We're doing a deep exploration into the previous day high and the previous day low.
The PDH and the PDL.
Exactly.
We are pulling our insights today from a massive stack of expert trading sources. We've got technical breakdowns, back-tested quantitative models, and some very painful real-world trading war stories.
The best kind of teachers.
They really are. We'll show you exactly what this strategy is, how to visualize the setups in the theater of your mind, and how to bulletproof your risk management. Because while everyone else is hunting for the next hot, lagging MCD or RSI crossover...
Oh, don't get me started on the RSI crossovers.
While they're doing that, the smart money is using yesterday's data to lay traps today. Yeah, and to truly leverage this strategy, we first have to fundamentally change how we view the daily candle itself.
Okay, let's unpack this.
Well, most traditional financial media fixates entirely on the opening and closing prices. I mean, you constantly hear analysts talking about where the Dow or the S&P 500 close.
Right, but why are we explicitly ignoring the open and the close here?
Yeah.
I mean, it feels counterintuitive. If I'm holding a stock in my retirement account, the closing price at the end of the year is literally the only number that matters to my net worth.
Sure. For long-term investing and, portfolio valuation, the close is absolutely vital. It represents the final consensus of value before the market goes to sleep.
Okay.
But intraday, day trading is an entirely different sport. Day trading is not about valuing a company's fundamentals. It is about hunting volatility and liquidity.
And volatility does not live at the consensus.
Exactly. Volatility lives at the extreme.
The absolute peak and the absolute valley of yesterday's session.
Let's break down what a high actually represents in the order book. When a market reaches its absolute high for the day, that is not just some random plot point on a graph.
Right.
That is the exact penny where the last, most aggressive buyer finally exhausted their capital. It is the absolute peak of bullish conviction, meeting a wall of institutional sell orders so massive that the buyers were instantly overwhelmed and rejected.
It's the moment the tide turned.
It is, and the low is the exact inverse. It is the moment of maximum panic.
The capitulation.
Yeah, it's where the final, terrified retail trader just capitulated and dumped their position, only to have their sell order absorbed by a massive institutional buyer stepping in to catch the falling knife.
Wow. So these 2 points represent peak emotion.
Peak emotion. And what's fascinating here is the concept of market memory. The market does not forget those emotional extremes.
I picture this like a physical battlefield.
Okay, I like that.
Imagine two armies fighting over a massive, sprawling valley. If they fought fiercely over one specific strategic hill yesterday, and one side eventually suffered massive casualties before finally taking the hill.
They aren't going to just casually ignore that terrain today.
Exactly. If the battle lines shift back toward that area today, that hill is still the most strategic choke point. Both armies remember the blood spilled there. They are going to fight over it again.
That analogy holds up perfectly when you look at how traders process regret. I mean, put yourself in the shoes of the market participants from yesterday.
Okay.
At yesterday's high, there is a group of buyers who managed to sell at the absolute top. They got a perfect exit, they booked maximum profit, and they are feeling incredibly confident.
The heroes of the day.
Right. But, crucially, there is also a group of short sellers who are watching that high, waiting for the price to tick up just 1 more cent to trigger their entry, and they missed it.
Oh, man. The psychological agony of the missed fill.
It's the worst.
It burns worse than an actual losing trade sometimes.
It really does. So today, when the price starts marching back up toward that exact same previous day high, both of those groups are hyper-focused on that level.
Interesting.
The buyers who sold at the top are thinking, I nailed it yesterday, I'm going to short it here today. And the sellers who missed their entry are thinking, this is my second chance, I am absolutely not missing it again.
Which means that specific price level is fundamentally different from just a random price in the middle of the chart.
Yeah.
It is loaded with kinetic energy.
Exactly. We call that energy liquidity. These levels act as massive gravitational magnets for price because they are immense liquidity pools.
Okay, let's define liquidity pool mechanically, because the sources talk about this constantly. But it's a term that gets thrown around on social media with, frankly, very little understanding of how the order book actually functions.
Yeah, it's become a bit of a buzzword. In simple terms, liquidity is the presence of resting limit orders.
Okay.
It is the ability for a large player to buy or sell a massive amount of an asset without drastically moving the price against themselves.
Which retail traders never have to worry about.
Never. Retail traders, people trading with a few $1,000s, never have to think about this. You hit the market buy button on your app, and your order of 50 shares is filled instantly at the current quote.
But if I'm a hedge fund manager, right, and I need to execute a buy order for 2 million shares of a stock.
You can't just hit market buy.
Right.
If you hit market buy with 2 million shares, your order will chew through every single resting sell limit order on the book. You will drive the price of the stock up 5, 10, maybe 15% in a matter of seconds.
Wow.
By the time your entire order is filled, your average entry price will be terrible. You will have completely ruined your own trade.
So if an institution wants to buy a massive amount of shares, they desperately need to find a massive cluster of people who are willing to sell at the exact same moment.
And where do you find massive, predictable clusters of sell orders? Right underneath yesterday's low.
Because everyone puts their stop loss there.
Exactly. Because every single retail trader who bought the asset today is looking at that chart, identifying yesterday's low as support, and placing their protective stop loss just below it.
And a stop loss on a long position is literally just an automated market sell order waiting to be triggered.
You got it. The smart money knows the liquidity is resting just above yesterday's high and just below yesterday's low. They don't have to predict the future. They don't have some magical crystal ball.
Right.
They simply position themselves at these exact predetermined levels to capitalize on the predictable emotional order flow of the retail masses.
So your very first step every single morning before you even look at the news, before you check Twitter, is to visualize the boundaries of the court.
Yes.
If you're listening right now, I want you to picture a completely clean chart. Strip away the moving averages, delete the oscillators, turn off the RSI. Just look at the 15-minute time frame with 2 perfectly horizontal lines framing the price action.
Keep it simple.
The previous day high at the top, the previous day low at the bottom. It gives you incredible clarity. You know exactly where the out-of-bounds lines are.
But as powerful as those boundaries are, simply knowing where the battlefield is located isn't quite enough to risk your capital. We need to add context.
Right, because if the price is aggressively marching toward yesterday's high, we need to know the weather conditions of the battle. Is the momentum fading, or is it a runaway freight train?
Exactly.
We've found the level, but now we need to evaluate the probability of the setup. And this is where we bring in a very select, highly specific set of contextual indicators.
And the single most important tool we overlay onto this clean chart is VWAP, volume-weighted average price.
I see so many retail traders treat VWAP like it's just another simple moving average, maybe a 20-period SMA, and they just get slaughtered.
Yeah.
The sources are very clear that VWAP is a fundamentally different beast.
Oh, completely different. A simple moving average is purely price-based. It takes the closing prices of the last 20 candles, adds them together, divides by 20, and plots a dot. It treats a candle where 1 million shares traded with the exact same mathematical weight as a candle where only 10 shares traded.
That makes no sense.
Right. It is completely blind to the actual effort and participation behind the price movement.
Whereas VWAP factors in the volume at every single price level. It calculates the true, undeniable average price that the entire market has paid for that asset since the opening bell.
It is the ultimate benchmark for institutional fair value. In fact, large algorithmic trading desks are frequently judged by their clients on whether they were able to execute their massive block orders below the VWAP for buys or above the VWAP for sells.
Wow, so it's a real performance metric for the big guys.
Exactly.
But the strategy in the sources doesn't just use the central VWAP line. The secret sauce is the VWAP standard deviation bands.
Right. Plotting the central VWAP line gives you equilibrium, but then you plot mathematical bands above and below it, typically set at 1 and 2 standard deviations. This creates a dynamic cloud or channel of value that expands and contracts based on the day's volatility. The upper bands act as dynamic, floating resistance, and the lower bands act as dynamic support.
So if the price is hovering above the central VWAP line, the market is broadly net long.
Yeah.
Buyers are in control today.
Yeah.
If it's below, the market is net short.
And here is where the synergy happens with our static lines. We are looking for what the sources call a multiplier effect, or double confluence.
Double confluence, I like that.
We want to see the exact moment when one of those dynamic, floating VWAP bands perfectly aligns and overlaps with our static, horizontal previous day high or low.
So let's paint this picture for the listener. The price drops down to yesterday's low. On its own, that's a potential bounce area.
Right.
But when you look closely, the lower -2 standard deviation VWAP band is sitting at that exact same penny.
That is double confluence. One indicator by itself might hold, or it might fail. But when two completely different mathematical models, one based entirely on yesterday's historical extreme, and one based entirely on today's live, volume-weighted fair value intersect at the exact same coordinate,
It's powerful.
it creates a highly reliable structural brick wall.
It acts as an incredible filter for bad trades too, doesn't it? If the price is hitting yesterday's high, but the upper VWAP band is miles away, it means the price hasn't even reached today's statistical extreme yet.
Exactly. Maybe you just sit that trade out. You wait for the confluence.
Okay, so VWAP provides our dynamic context, but the sources also introduce a static way to map the internal structure of yesterday's range using Fibonacci retracements and Gann box logic.
Yeah, this is a great tool.
This was fascinating to read. You take your Fibonacci tool on your charting software and you draw it from yesterday's absolute low to yesterday's absolute high. You are basically slicing up that 24-hour range into percentage blocks. But the sources don't focus on the traditional 61.8% golden ratio that everyone else talks about. They highlight the 25%, 50%, and 70% levels.
And this relates directly to reading the momentum of the market. The most lucrative setups, the trades that are going to trend hard, offer massive reward-to-risk ratios and move quickly happen when the price only pulls back to the 25% mark of yesterday's range before impulsing back in the direction of the trend.
A 25% retracement is incredibly shallow.
It is very shallow. The mathematical implication of a 25% retracement is that the market is so incredibly eager to continue yesterday's trend that institutional buyers are not even willing to wait for a deep discount.
Wow.
They are stepping in aggressively, absorbing all selling pressure right near the highs. That signals massive underlying strength.
But the data in the sources points out that if the price breaks past the 70% retracement level, the structural integrity of the setup is completely shattered.
Yeah, if the market gives back 70% of yesterday's gains, you are no longer in an impulsive continuation environment. You are in a deep mean reversion cycle, or potentially witnessing a complete trend reversal.
The trend is basically dead at that point.
Pretty much. The statistical probability of making a new sustained high drops precipitously once that 70% threshold is breached.
Okay, let's unpack this structural logic for a second because I want to challenge a contradiction I noticed in the material.
Okay, let's hear it.
We have our extremes, the 0% at the low, the 100% at the high. And you just established that shallow 25% pullbacks are fantastic for catching strong momentum.
Right.
But then the outline dedicates an entire section to Ganbox logic, which focuses heavily on the middle of the range, specifically this shaded neutral zone between the 38.2% and 61.8% levels.
Yeah.
If the absolute extremes are the best places to trade and shallow pullbacks show the best momentum, why do we care at all about this messy middle area?
That is the exact trap that overactive day traders fall into. We care deeply about that middle zone precisely so we know when not to trade. W. D. Gann's market structure philosophy dictates that the area around the 50% retracement is the meat grinder.
The meat grinder. That perfectly describes how it feels to trade in there.
It is the ultimate battleground of indecision. When price is hovering around the 50% mark of yesterday's range, neither the buyers nor the sellers have established clear control.
It's just chop.
It is a low conviction environment. This is where market makers will intentionally chop the price up and down, triggering tight stop losses and shaking out impatient retail traders before the market finally commits to a real directional move.
So it's a zone to avoid.
Completely.
Yeah.
The primary inviolable rule of the Ganbox logic is do not initiate new breakout trades while price is trapped in this neutral zone.
It's just a massive flashing do not enter sign right in the center of your screen.
But there is a secondary principle tied to this known as the first touch rule, which explains the crucial relationship between those extremes and the messy middle.
Walk us through the mechanics of the first touch rule.
When the price of an asset touches the 0% extreme yesterday's low or the 100% extreme yesterday's high, for the very first time in the current trading session, the statistical bias is heavily skewed toward a rejection.
Really?
Yes, there is a very high probability that the price will bounce off that extreme and attempt to revert back toward that 50% equilibrium center zone.
Because that extreme level acts like a thick rubber band that has been stretched to its absolute physical limit.
It's basic market mechanics. Think about who is acting at that exact moment.
Okay.
The first touch of the previous day high triggers immediate profit taking by the smart money who bought early in the morning.
Right.
Simultaneously, mean reversion algorithms and counter-trend traders start opening short positions. These two massive forces of selling pressure naturally snap the price back toward the middle.
So if you see the market open and price immediately rockets straight up toward yesterday's high in the first 30 minutes of the day, and it's the very first time it's testing that level,
Do not buy it.
you should absolutely not be blindly buying that breakout. The math suggests it needs to pull back and breathe first.
Chasing that first touch is exactly how retail traders provide liquidity to the institutions taking their profits.
Here's where it gets really interesting. We have our boundaries. We understand the context with the VWAP clouds and the Fibonacci zones. But what actually happens when the rubber meets the road?
The moment of truth.
Right. When that live ticking price action violently collides with our previous day high or low line, because it rarely just sits there peacefully. We are transitioning now from our theoretical pre-market preparation to live split-second execution.
This is the crucible. Every single time price interacts with the PDH or PDL, it is going to do one of two things. It is going to achieve a real breakout, or it is going to print a fake out and aggressively reject.
And your survival as a trader dictates that you correctly identify which scenario is playing out in real time with real money on the line.
Yeah.
Let's start with the real breakout.
Yeah.
How do we mechanically confirm it's a real move and not a trap designed to steal our money? Because the sources use a very specific mathematical filter here called an ATR buffer.
Yes, ATR stands for average true range. It is a brilliant non-directional indicator that measures the pure volatility of the asset.
Non-directional meaning it doesn't care if it's going up or down.
Right. It doesn't tell you the trend. It simply calculates, on average, how many dollars and cents the price is expanding during each candle period.
And we're using the standard 14-period ATR setting.
Yes. To confirm a genuine breakout, you cannot just watch the price cross your line by a single penny. A 1-cent breach means nothing in a high-frequency trading environment.
It's just noise.
It's just noise. You need a buffer zone, a no man's land, to filter out random algorithmic noise. You establish this by taking the current ATR value and applying a multiplier, typically between 0.1 and 0.3.
Okay, let's do the math out loud so we can visualize it. Say I'm looking at a stock, and the 14-period ATR is currently showing 50 cents of average volatility per candle.
Yeah.
I multiply that 50 cents by our buffer, say 0.2, that gives me 10 cents.
Correct.
My buffer zone is exactly 10 cents wide.
Precisely. So if yesterday's high is exactly $100, you do not even consider it a breakout until the price pushes past $100.10. That buffer demands that the market prove its strength.
Got it.
But even crossing the buffer is not the final signal. You must wait for the candle to actually close. Specifically, you need a 1-minute or a 5-minute candle to lock in its final price and close firmly beyond that buffer zone.
And the physical shape of that closed candle matters immensely. The sources emphasize it needs a solid body.
Oh, absolutely. You want to see a thick, robust candle body with very little wick on the top. A large body indicates absolute conviction from the buyers. Furthermore, you must look down at the volume bars at the bottom of your screen.
The volume.
A real breakout demands a clear, undeniable surge in volume.
Why is the volume so critical mechanically? What is happening in the order book when we see that?
Well, high volume is the footprint of the institutions.
Okay.
When price breaks a major level, like a previous day high, it runs into a massive wall of retail sell orders. If a breakout happens on low volume, it means only a trickle of small retail buyers are pushing the price up.
And they're going to get crushed.
Right. The moment they hit that institutional sell wall, the price will collapse. But a high volume surge means institutional block orders are aggressively stepping in, actively absorbing all of that resting sell pressure, and forcefully driving the price higher.
They're chewing through the wall.
Exactly.
Yeah.
High volume validates the move.
I picture a real breakout like a high-speed train leaving the station. Once those brakes release and the engine engages, there is no hesitation, no rolling backward. It just grips the tracks and goes.
That sustained momentum is the hallmark of a true breakout. But then we have the dark side, the fake out, the rejection.
Ah, the fake out. If a breakout is a high-speed train, reading the sources made me realize a fake out is not just a train breaking down, it's much more violent.
Oh, much more.
It feels more like pushing open a massive, heavy industrial steeled fire door that is attached to a giant coiled spring.
That's a great way to look at it.
You can use all your body weight to shove that door open and step outside the building, which is the price breaking out of the range. But the second you lose your momentum, the second your foot slips, that massive spring violently snaps the heavy door back shut. And if you are caught standing in the doorway, you get crushed.
That is a brutally accurate metaphor for what we call a liquidity sweep. Visually, on your chart, getting crushed in that doorway leaves behind a very specific scar. A long wick.
The candle tail.
Right. The price breaks the previous day high, it triggers the breakout alerts, and maybe even pushes past your 10-cent APR buffer for 30 or 40 seconds.
Luring everyone in.
But before that 5-minute candle can actually finish and close, an overwhelming flood of institutional sell orders hits the tape. They aggressively drive the price all the way back down.
And when the 5-minute timer finally ticks to 0, the candle ends up closing back inside the previous day's range. It leaves behind this long, thin, ugly line pointing up above the boundary.
That wick is the literal visual representation of a failed breakout. It shows exactly how far the buyers got before they were ambushed. And just like the real breakout, you want to see a massive volume spike on a fake out. But in this scenario, the high volume confirms that the breakout attempt was actively and aggressively countered by the opposing side. It is the sound of the trap snapping shut.
And the subsequent retest is the final nail in the coffin. With a real breakout, the price might pop up, come back down to gently touch the line again, and that old resistance instantly acts as new support, bouncing the price higher. But with a fake out.
With a fake out, the structure is broken. When price falls back down to retest the line, it slices right back down through it as if it were made of paper. The support completely vanishes because it was never really there to begin with.
I want to spend some time breaking down a specific, incredibly painful example from the sources that perfectly illustrates the mechanics of this trap. The trader described it as the absolute worst trade they'd ever taken, and it involved Bitcoin.
Ah, the Bitcoin trap. It is a masterclass in institutional manipulation. Every trader needs to understand this sequence.
So let's set the stage.
No.
Put yourself at the desk. Bitcoin was in a massive, textbook, multi-day uptrend. It was printing higher highs and higher lows.
The holy grail of trends.
Exactly. The sentiment on Twitter was euphoric. Everyone was bullish. Then during the morning session, it starts to pull back. It drops down methodically until it perfectly touches yesterday's low.
Okay.
To a retail trader, this looks like a gift. The trend is up and is testing a major daily support level. The trader thinks this is the easiest bounce trade of my life, and they buy heavily, risking a huge portion of their account.
And structurally, they aren't completely wrong to look at that level. The trend was up. It was testing support.
Exactly. They followed the basic textbook. But 30 minutes later, the price starts to bleed. It slips below the line, it hits their stop loss, they are out of the position, forced to take a painful loss.
Ouch. Oh.
But then, the absolute most infuriating thing happens. The exact minute their stop loss is triggered, Bitcoin violently reverses. It prints a massive green candle and rockets higher, trending harder than it had all week. It goes exactly where the trader thought it would go, but only after taking that money.
And this highlights the tragic gap between knowing technical analysis and understanding market mechanics.
Yes.
The trader was entirely correct that the previous day low was a critical area of interest. They were just fundamentally wrong about how the smart money was planning to interact with it.
This is the infamous liquidity grab. It's also known in some circles as the turtle soup model. Explain the underlying mechanics of this raid because it is sinister.
It is a bit sinister, yeah. Let's look at the order book. Think about the thousands of retail traders who bought Bitcoin as it dipped toward yesterday's low. Every single one of them was taught the exact same risk management rule. Put your stop loss just underneath the support level.
Because the logic is, if it breaks the line, the thesis is wrong, so you want the computer to automatically sell your position to protect your capital.
Precisely. Which means there is a massive, highly concentrated cluster of automated sell orders resting just a few dollars below the previous day low.
A goldmine of liquidity.
Now, switch perspectives. You are a massive algorithmic trading fund. You want to initiate a huge long position in Bitcoin to ride the macro uptrend. But as we discussed earlier, if you just buy, you'll spike the price and ruin your entry.
Right.
You desperately need thousands of people to sell to you at the same time.
Oh, wow. So the institution doesn't just wait for the price to fall. They actively push the price down through the support line intentionally.
They do. They will spend a small amount of capital to aggressively short the market, driving the price just far enough below the previous day low to trigger that massive cluster of retail stop losses.
That is wild.
The moment those stocks are hit, thousands of automated sell orders instantly flood the market.
It creates a wave of forced selling.
And the institution is standing right there at the bottom with their massive net open, absorbing all of that forced selling at a steep discount.
Yeah.
They use the retail panic to fill their massive long position invisibly without causing slippage. Once their order is completely filled, they stop suppressing the price, and the true explosive upward move begins. They literally grabbed the retail liquidity to fuel their own rocket ship.
So when we see a fake out, it isn't just the market randomly changing its mind. It is a highly orchestrated raid. They are hunting the stops.
Which is exactly why you cannot blindly place a limit order exactly on the line and hope to the best.
Right.
You have to wait for the candle to develop, you have to look for the formation of the wick, and you have to anticipate the hunt. As one of the veteran traders in the sources noted, and I love this quote, violence means institutional interest. Chop means confusion. You are looking for the violent footprints of the big players executing their sweeps?
Okay, let's unpack this because I have a major mechanical issue with these rules.
Let's hear it.
You're telling me that to confirm a breakout or a fake out, I have to wait for an entire 5-minute candle to close. Say we're trading the NASDAQ index at the New York Open. In 5 minutes, the NASDAQ can easily move 60 or 70 points.
Easily.
If I wait for that candle to close, my entry is going to be incredibly late. I'll be buying at the very top of the candle, and my stop loss now has to be miles away just to be safe. Aren't I completely destroying my risk-to-reward ratio by waiting for this so-called confirmation?
That is the exact agonizing dilemma that traps 90% of breakout traders.
Right.
You are identifying the precise flaw in trading high time frame levels without lower time frame mechanics. If you only look at the 5-minute chart, you will almost always enter late, and your stop loss will be far too wide.
So what's the solution?
That is exactly why the sources pivot into the absolute necessity of lower time frame precision entries.
Okay, so we are transitioning now from recognizing the broad pattern on the daily or hourly chart to actually pulling the trigger with surgical precision. And the cornerstone of this precision entry is a framework heavily utilized in ICT, or inner circle trader, methodologies. It's called the AMD model.
Yes. AMD stands for Accumulation, Manipulation, Distribution. It is a structural map of how algorithmic market makers design a daily trading session.
Let's break down each phase mechanically. Let's assume we have our VWAP confluence, we are bouncing off yesterday's low, and we are looking for a highly profitable bullish day. We want the market to go up. How does the AMD model begin?
Phase 1 is accumulation. The daily session opens and the price just drifts. It chops sideways in a tight, boring range. Retail traders get frustrated and chopped out, but what is actually happening is that smart money is quietly and methodically building their initial long positions.
They're hoarding it.
They are buying slowly, keeping the price contained so they don't tip their hand.
Then comes phase two. Scary part. Manipulation.
Right. On a day that is fundamentally designed to be heavily bullish, the initial explosive move is almost always entirely fake. It is a bearish dive.
A trap.
Price drops aggressively below the opening price. This is the manipulation phase. Its sole purpose is to sweep the liquidity resting below a previous low, very often sweeping the low of the previous candle close, or PCC.
So to anyone watching the live chart, it looks like the market is absolutely crashing. It forces the late longs to panic sell, and it tricks breakout traders into shorting the bottom.
Exactly. It creates that long lower wick on the daily time frame. It is running the exact turtle soup liquidity grab play we just discussed, but on a micro scale.
Incredible.
Once the stops are triggered and liquidity is fully secured by the algorithms, we immediately enter the final, most lucrative phase. Distribution.
The rocket ship takes off.
Price violently reverses upward, crosses rapidly back above the opening price, and trends strongly for the rest of the session, ultimately forming the large, solid green body of the daily candle. They accumulate quietly, manipulate down to grab the stops, and then distribute the massive moves upward to cash out.
So how do we actually trade this without getting caught in the manipulation phase? The sources outline a very specific mechanical sequence called the three-candle setup.
The three-candle setup systemizes your entry criteria. You identify your setup candle, which we'll call candle 1. This is the candle that establishes the specific micro high or low that you are targeting for a sweep.
Okay.
You wait for candle 2 to form, which usually just chops around. Then on candle 3, you are watching like a hawk for price to aggressively come back and pierce the high or low of candle 1.
Okay, so candle 3 is the manipulation. It's the one testing the level and sweeping the liquidity. But we still aren't just blindly buying the moment it touches the line, right?
No, absolutely not. When candle 3 hits that level, you execute a concept called fractal time frame analysis. You step down your time frame.
I love visualizing this, like stepping down a staircase.
It's a great visual.
You start on the daily chart. You mark your previous day high and low. That's the top of the stairs, give you the massive big picture boundaries.
Yeah.
Then, as the price starts approaching the line during the session, you step down to the 1-hour chart. You're watching the approach. Is it gaining momentum? Is the volume building?
All right.
And then, right as the price physically collides with the line, right as candle 3 sweeps the level, you step down again, zooming in with a microscope to the 1-minute or the 5-minute chart.
And on that micro 5-minute chart, you are hunting for a very specific, violent sequence. You want to see the price sweep the level and then instantly reverse with enough force to break the local market structure. This is referred to as a change of character or a break and retest.
Walk me through exactly what a change of character looks like on a 5-minute chart. Let's use gold, for instance, just to mix up the assets. XAUSD.
Oh, gold is perfect for this. It respects these levels beautifully. Imagine gold is dropping toward yesterday's low to perform the sweep. On the 5-minute chart, it is printing a clear, undeniable downtrend. Lower highs, lower lows, lower highs, lower lows.
Right.
But the moment it sweeps the liquidity below yesterday's low, it suddenly prints a massive green candle that blasts straight upward, completely ignoring the previous lower high and breaking above it.
It violently snaps the downtrend structure.
That is the change of character. The mechanical momentum has definitively shifted from the sellers to the buyers. But even then, you do not buy the top of that massive green candle. You wait.
Why are we still waiting? We have the shift.
Because that explosive upward move almost always leaves behind what is called an order block or a fair value gap.
Okay, define a fair value gap, because this is an ICT concept that trips up a lot of people.
We need to talk about what a fair value gap actually represents in the order book. When you see that massive explosive green candle that breaks structure, it's not just a bunch of people casually deciding to buy at once.
Right.
It is an algorithmic sweeping of the book. The price moves so incredibly fast, driven by massive market buy orders, that the limit orders resting on the book are literally skipped over. It leaves a physical vacuum on the chart where no trading occurred.
It's like a high-speed express train blowing past a local commuter station. The passengers are still standing on the platform holding their tickets, but the train was moving too fast to stop.
Perfect analogy. And the market hates a vacuum. Eventually, a local train has to come back down the track to pick up those stranded passengers before heading to the final destination. price will almost invariably pull back to that exact gap to fill those missed orders, to offer fair value to both buyers and sellers, before continuing its true impulsive direction.
So your precision entry is placing your buy limit order exactly inside that fair value gap or order block.
Exactly.
You are getting in after the smart money has revealed their hand by breaking structure, but before the main trend really takes off. It gives you an incredibly tight stop loss and massive upside potential.
And the sources provide fantastic examples of this using AUD/USD forex pairs and NASDAQ futures charts, illustrating that exact break, change of character, and retest entry method. But they also add a fascinating element that most retail traders ignore completely: the element of time.
It's not just about the price level, it's about the clock on the wall.
Time and price are equally important. The sources specifically highlight two critical temporal levels: the midnight, which is 00.0000 Eastern Standard Time opening price, and the 8:30 a.m. Eastern Standard Time opening price.
Why are those specific times magical?
Well, midnight EST is widely considered the true daily open in global algorithmic tracking systems. It resets the daily tracking metrics for massive institutional funds trading around the world.
Okay.
And 8:30 a.m. EST is crucial because it coincides precisely with the release of major U.S. economic data like CPI or non-farm payrolls.
Right, the news drops.
Exactly. And it marks the massive ramp-up of institutional volume right before the physical New York Stock Exchange opens at 9:30 a.m.
So how do we use these times with our PDL strategy?
If you are looking for a bullish trade, you want to go long off a previous day low bounce. The absolute highest probability setup occurs when you are executing your entry below the midnight opening price, below the 8:30 a.m. opening price, and below the previous day's low.
Because if you are below all three of those critical benchmarks, you are deep in the discount territory. You are buying the fear.
Yes, you're entering exactly inside the manipulation phase of the AMD model, right? Where the smart money algorithms are programmed to accumulate their massive positions.
It creates an incredibly robust structural framework. You aren't guessing. You are waiting for time, price, and algorithmic structure to align perfectly.
It's a beautiful thing when it all lines up.
So what does this all mean? We have this incredibly powerful framework. We know where the lines are. We have our VWAP confluence to filter out the noise. We know how to identify the heavy door of a fake out, and we know exactly how to step down the staircase to the 5-minute chart to find our micro entry on a fair value gap below the midnight open.
It sounds absolutely foolproof.
It does. Which brings us to the most dangerous, critical part of this entire deep dive.
Right, because having the perfect AMD entry model means absolutely nothing if you blow up your trading account on one bad day.
Exactly. We have to transition now from the technical mechanics of the strategy to the vital, non-negotiable rules of mathematical survival, risk management, and trading psychology.
You can have a masterfully designed strategy with an 80% win rate, but if you do not strictly manage your risk, that remaining 20% of inevitable losses will wipe out your entire portfolio.
The math is brutal.
The mathematical reality of compounding drawdowns in trading is completely unforgiving.
Let's start with the golden rule of survival, the risk per trade.
The expert sources are completely unanimous on this metric. You must risk strictly 1% to 2% of your total account equity on any single trade. No exceptions, no matter how confident you feel about the setup.
Let's do the math on that, because I know new traders hear 1% and think that's so tiny. If I have a $10,000 account, 1% is $100. Are you telling me I can only buy $100 worth of a stock? I'll never make a living doing that.
That is the most common fundamental misunderstanding in retail trading. Risking 1% does absolutely not refer to your position size. It refers exclusively to your maximum potential capital loss if your trade fails and your stop loss gets hit.
Okay, break that down for us mechanically. Let's use that $10,000 account example.
Sure. 1% risk means you are willing to lose exactly $100 on this setup. Now, let's say you spot a perfect 5-minute order block entry at yesterday's low.
Right.
You calculate that based on the chart structure, your stop loss needs to be placed 50 cents below your entry price to be protected from a random wick.
Okay, so I have $100 of risk and a 50-cent stop loss.
You take your total risk, the $100, and you divide it by the distance to your stop loss, which is $0.50. 100 divided by 0.5 is 200. That means you can buy exactly 200 shares of the stock.
So my actual position size is 200 shares.
Exactly.
If the stock drops 50 cents and hits my stop, 200 shares times 50 cents is $100. I lose exactly 1% of my account.
You got it. Now imagine the market is incredibly volatile today and that 50-cent stop is too tight. You need a wider, safer stop loss of $1.
Right.
Your financial risk remains exactly the same, $100. So you divide $100 by $1, and your position size is now adjusted down to 100 shares. You dynamically adjust your position size based on the structural distance to your stop loss, ensuring that your financial damage is always capped at a constant, flat 1%.
This math is how you survive the inevitable drawdowns. If you hit a terrible losing streak, maybe the market conditions change and you lose 5 trades in a row, you have only lost 5% of your total account capital.
You are fully intact.
You are completely in the game. You only need one good 1 to 5 risk-reward trade to make it all back.
Yeah.
But this brings up a tactical question. Where exactly do we put the stop loss when we are trading these PDH and PDL levels?
It depends on which scenario you are trading. For a true confirmed breakout where the solid 5-minute candle closes powerfully outside your ATR buffer zone, you want to keep it simple and structural. Place your stop just below the body of the setup candle, or just tuck safely back underneath the previous day boundary line itself. If it is a genuine, institutionally backed breakout, it has no business falling back below that line.
But what about the fake out, the rejection trades, where we are playing the liquidity sweep? Because visually, those leave behind massive long wicks.
Right.
If you put your stop loss all the way at the very tip of a giant wick, the distance is huge. Which means, based on the math we just did, your position size has to be tiny, destroying your profit potential.
The sources offer a brilliant, highly nuanced tactical adjustment specifically for rejection wicks. When trading a fake out, you do not put your stop at the extreme tip of the wick.
Where does it go?
You place your stop loss exactly at the halfway point of that long wick.
The 50% mark of the candle tail. Why there?
Think about the intense micro tug of war that physically created that wick. Buyers violently pushed the price way up, and sellers aggressively slammed it right back down. The absolute midpoint of that wick represents the mathematical equilibrium of that specific micro battle. If you enter a short trade based on the rejection and the price reverses against you, climbing back up and crossing over that 50% halfway mark,
it signals a massive shift.
Exactly. It means the buyers have entirely regained control of the microstructure.
The rejection thesis is dead.
The thesis is dead. If it crosses the halfway point with momentum, it is highly statistically probable that the algorithms are driving it straight back to the absolute top of the wick to hunt the resting stops anyway.
So you simply cut the trade early. You give the trade enough room to breathe and fluctuate, but you refuse to stick around and get run over if the underlying thesis is invalidated.
It's about protecting capital.
That is such a smart professional detail. Okay, so we know our mathematical risk. We know exactly where our stop goes. What about the reward? Where are we systematically taking profits?
Well, the standard textbook quantitative approach is to aim for a strict 1.2 reward-to-risk ratio. If you are risking your $100, your target limit order is placed at a level that generates $200 of profit.
Standard stuff.
However, the expert sources suggest a slightly more conservative, high-probability approach, aiming for a 1.1.25 ratio.
Risking $100 to make $125. Why lower the target and leave money on the table?
Because in live market conditions, a 1.1.25 target will get triggered much, much more frequently than a 1.2 target.
Oh, I see.
Securing consistent base hits dramatically increases your overall win rate. And in day trading, a high win rate builds invaluable psychological capital.
Keeps you sane.
Yes, it keeps you confident in the system, preventing you from tinkering with the rules during a drawdown. But beyond fixed ratios, there is also a beautiful structural method for taking profits inherent to the strategy itself.
The pinball effect.
Exactly. If you successfully execute a long trade on a liquidity sweep and bounce off the previous day low, your most logical, structurally sound profit target is the complete opposite side of yesterday's range.
The previous day high.
Yes. In ranging choppy market conditions, the price will literally bounce back and forth between the PDH and the PDL like a pinball for days on end. Like we were talking about gold earlier, it does this all the time. It sweeps the bottom, hits the top, sweeps the top, hits the bottom.
Which is an amazing paradigm shift because most retail traders absolutely despise choppy ranging markets. They get chopped to pieces trying to force trend continuation strategies in a market that is going nowhere.
But with this PDH-PDL system, a ranging market is actually a gold mine. You are systematically buying the bottom boundary and selling the top boundary, harvesting the chop.
But, and this is a massive critical light, but executing this requires immense, almost robotic psychological discipline.
Oh, without a doubt.
Trading these invisible lines is fundamentally an exercise in mastering your own FOMO, the fear of missing out.
It really is.
I know exactly what you mean. It is physically uncomfortable to sit on your hands. You see the price rocketing toward yesterday's high. Big, thick green candles are printing.
The alarms are going off.
Right. Your heart rate elevates, adrenaline kicks in, your brain is screaming that a massive breakout is happening right now, and you feel this overwhelming urge to jump in early, before the candle closes, so you can get a better entry price.
And giving into that exact adrenaline rush is how you become the liquidity for the institutional sweep.
You get trapped right in the doorway.
The cardinal unbreakable rule of this strategy is, do not chase the initial touch of the line. You must embrace the discomfort of waiting for the candle to close.
Even when it looks like a sure thing.
Especially then. A 5-minute candle that looks like a massive, unstoppable, bullish breakout with 60 seconds left on the clock can instantly collapse into a bearish, devastating rejection wick in the final 10 seconds.
You are intentionally waiting for confirmation. You are consciously sacrificing the absolute perfect bottom-tick entry price, and in exchange, you are buying probability, certainty, and structural confirmation.
And you also have to develop the maturity to accept that sometimes the market simply isn't offering a clean setup. If a breakout happens, but the volume is completely dead, it's likely a trap. Ignore it.
Okay.
If the overall market is incredibly choppy or there is a massive macro news event like the Federal Reserve interest rate decision coming out in 10 minutes, the statistical edge of this technical strategy is temporarily obliterated by fundamental volatility.
In those chaotic moments, physically taking your hands off the keyboard and sitting out the trade is an active, highly profitable decision. Capital preservation is an offensive strategy.
Exactly.
I think the hardest part of adopting this entire framework is shifting your identity as a trader.
Yeah.
You have to stop acting like a gambler trying to magically predict where the wiggling line on the screen is going to go next.
You have to become a sniper.
Yes. You patiently wait in the blind for the smart money algorithms to reveal their positioning through volume and structure, and then you simply align your tiny capital with their massive momentum.
The market provides endless opportunities. There is always a brand new previous day high and a new previous day low being minted at midnight. The market will always present another mathematically sound setup tomorrow.
Patience is not just a moral virtue in trading. It is a measurable quantitative edge.
Well said.
Okay, let's bring this massive framework all together. We started with a muddy, cluttered chart full of blinking lights, and we stripped it down to the absolute bare essentials. Every single morning, your routine starts by marking the absolute high and the absolute low of yesterday's session.
Yep.
You map your internal Fibonacci structure to locate that 25% momentum zone and avoid the 50% meat grinder. You overlay your dynamic VWAP bands, hunting for that powerful double confluence brick wall.
You wait patiently, ignoring the noise, until price physically reaches your extreme boundaries. If it attempts to break out, you wait for the 5-minute candle to close solidly outside your mathematically defined ATR buffer, demanding strong volume to validate the move.
And if it rejects, you look for that violent long wick closing back inside the range, confirming that a smart money liquidity grab just occurred.
Exactly. To avoid entering late and ruining your risk to reward, you step down your time frames. You use the AMD model.
You zoom into the 5-minute chart to look for a change of character and an order block entry, ideally timing it beneath the midnight open to secure a massive institutional discount.
You lock in your risk to a strict, mathematically calculated 1% to 2%, placing your stop dynamically either below the setup candle or at the exact halfway point of the rejection wick.
And then you take your hands off the mouse. You let the market mechanics do the heavy lifting, targeting a 1.1.25 ratio or aiming for the opposite side of the daily range pinball machine.
It is a complete mechanical, professional framework that methodically removes the emotional guesswork and the gambling mentality from day trading.
It really is a complete paradigm shift. And I'll leave you with a final, slightly provocative thought to mull over, something we touched on earlier that just completely rewires how you view these flashing numbers on your screen.
Yeah, if we pull all the way back and connect the mechanics of liquidity pools and the AMD model to the bigger picture, it forces you to ask a fascinating, almost philosophical question about the nature of the market itself.
With that,
What if the market isn't a chaotic, unpredictable ocean of random numbers? What if it's not a casino driven by pure chance?
okay.
What if, instead, the market is a highly orchestrated, recurring, algorithmic dance built entirely around harvesting the emotional extremes of yesterday?
Wow.
What if every single chart you look at isn't just a record of price, but a literal, measurable map of collective human memory?
A map of fear, greed, regret, and the invisible institutional footprints that methodically prey on them. Next time you sit down at your desk and open your charting software, don't look for the indicators. Don't look for the crossovers. Look for the memory.
That's the real game.
We'd love to hear how you apply this. Do you actively use previous day highs and lows in your own charting routines? Have you ever found yourself trapped in that liquidity sweep doorway? And what has your experience been with these invisible boundaries? Let us know. Because once you understand the mechanics, once you see the X-ray clearly, the muddy waters finally start to make perfect sense.